Hej och välkommen tillbaka. Jag heter Markus Almerud och jag är analytiker här på banken. Jag kommer nu byta till engelska för presentatör pratar engelska. So a warm welcome to you. We have Scanfil here and Christophe Sut who is going to present the company, and then I'll come back with Q&A later. So over to you.
Thank you very much. Thanks for giving us the opportunity to introduce our company tonight. So very happy to start straight away. Scanfil is a Finnish company originally created 1976, and the world where we are evolving into is the world of electronic manufacturing. We are actually building either electronic boards or full products for our clients that are usually industrials company. And that's what we try to do in a good way every day. We have a certain number of values that we try to build our operations on. One is to be customer focused. I mean, obviously we are mainly a service company, so supporting, being close to our customers is something that is important to us. It goes with the next one, which is achieving together. We work closely within the company to create this value, to optimize what we do, but also extremely closely with our customer. We'll get back to it in a moment, but the business we are in is not a simple business, so it requests very close interaction between our customers and our teams. We try to empower our team. We are, you will see later, quite global players today. We have operation from Australia, China, all the way to US. We're still a very heavyweight in Europe, so therefore it's very important for us that anyone that runs an operation for us is capable to take the action and to take decision when they need to be taken. And then finally, we have performance as one element of our values, because we are in manufacturing, and in manufacturing you need to make sure that you deliver in cost, deliver in quality, deliver in time, and those are the things that drive us in what we do. The way we are organized today, and I was mentioning before, we have currently 4 regions. The company is roughly 800 million euros, and we have 4 regions, starting with the APAC regions, that is in the range of 200 million euros, and that has actually 3 factories located in Australia, Malaysia, which are both of them recent acquisition, and then China, where we have a long-standing operation and where we have a quite sizable and very modern factory there. Then Europe is divided in 2 regions for us, Northern Europe and what we call Central Europe. In Northern Europe, we have 4 operations, 2 in Sweden, in Åtvidaberg and Malmö. 1 in Finland, in Sievi, that is actually the original site for the company. And then finally a bigger site located in Estonia, in Pärnu. And then the 3rd region is Central Europe, where we have 2 big factories, one focusing on electronic manufacturing in Sieradz, Poland. The second one a few hundred kilometers away in Mysłowice, that do system integration, meaning building more complete products and having mechanical capabilities in Central Europe. And then finally we have an operation in Germany. And then the last region is Americas, which is a region that is smallest for us. We have only 1 operation in Atlanta, and where we started recently, 1.5 years ago, to have electronic manufacturing. And that was mainly driven by our customer portfolio, our customers were basically asking us to have capabilities for manufacturing in the US, partly driven by the change in the geopolitical environment, but also driven by their development. And you can see on that picture the split of our factory and all the factory we are having. And we have roughly 3,800 employees as of now. I would say the biggest part of our biggest operation, as I was mentioning before, are actually located in Poland, where we have 2 sizable factories in Suzhou, China, and then in Pärnu, Estonia. The other factory are smaller size operations than those 4. In terms of what we do and why we do what we do, I mentioned earlier we work mainly for industrial customers, meaning that when you look at the business of contract manufacturing and electronic manufacturing, you could split it in three different segments. You get players that are focused on building consumer goods. They will build mobile phone, they will build goods that are in extremely high volume. And what it will usually result is a lot of automation, extremely cost competitive, and very short life cycle of those products because they rotate quite fast. Then on the opposite, you will have the type of customer that are building very small volumes. And in reality, we stand a little bit in the middle of that. The customer we operate with are customers that will have a mid volume, that will, however, have a very high level of complexity in their operation, and that usually will operate in the world of industrial goods. So people that we work with, and you can read it in reports, and for some of them it's public information, are companies, for example, like Danfoss, like ABB, that are playing in that segment. I mean, they have actually a high level of complexity because usually their product is not a single product, it's an integration of several products. But they still reach a level of volume that is significant, which means that for us, the main capabilities we develop is being efficient and building automation to a level that still allow us to keep a good level of flexibility. Just because none of our factory is dedicated to a customer, none of our line is dedicated of the manufacturing of our customer. So the change over time becomes very important. And we do that when we produce that. We obviously produce electronic boards as a single component, but very often we take this electronic board and we will put it either in a sub-assembly that will go in the final product, or we will go all the way and produce the final product for our customers. A company that I'm sure you all know, at least for going to supermarket in the evening, is Tomra, that is doing the recycling machine for a bottle, and that's a company that we produce actually the full product for them. So we deliver to their customer or to their local operation the full product. And that's the type of business we are into. Based on that, I think we have a strategy that is quite simple. It's built on, I will say, two main axes. One is related to what we call efficiency. And there we have a couple of initiatives. I would say in our industry, what is important is obviously supply chain. I mean, supply chain is an extremely important element in our industry because it's actually an enormous amount of money that goes through us in that scenario. And we need both to manage the relationship with the suppliers to make sure we deliver to the clients in good time, but also have a good flow in managing the goods and managing the components. The second element we work on is obviously productivity. Our competitiveness allows us to win deals and to move forward with them. And then the last strategical element on the efficiency is what we call Dream Factory, which is in a way the capability we have to evolve our factory to a point where they are highly efficient, remaining highly flexible, which is, I will say, the whole competence and knowledge that we develop in the company. And those programs are developed and adjusted to each of our sites by the local teams, but with a common thread where everyone is encouraged to work on those elements and to share about those elements. When it comes to the second axis, we are working with growth, and for that we have a few things that are key for us. As I said before, we don't serve whatever type of segment. We have identified the industrial world as our main target. And here we have split it in three different sub-segments. One being what we call energy and clean tech. I mean, we have quite significant footprint with customers in the world of energy clean tech. Can go from a solution for grid balancing for electricity network to recycling machine to charger for electrical vehicles. At least the industrial type of chargers. And that's one of the segments, and that is a segment that we have selected for two reasons. I think historically, I would say we got probably the chance at one point in time to have a very broad portfolio in that sector, and it has driven our growth for quite many years. We have also now developed quite good level of competence. We know how to manage those things and get traction to those customers. And then the second thing is that when you look at the growth of our industry, people talk about 5 to 6%. When you look at the growth of this segment for our industry, we talk about 10 to 11%. So that's something that we want to capitalize on the long-term trend. The second segment we are serving is medtech. Medtech has a couple of benefits. It has also a growth rate that is higher than the rest of the industry. But it has also the benefit to have very, very long-term contract. And here what we produce is, for example, measurement device that will be used in medical application. And there again, you get quite a high level of complexity, you get a level of certification that is specific, and there you get also a long-term relationship with your customers. And then finally, we have one segment that is a bit more generic because we call it industrial, which in reality can include quite a few different things. It can include defense sector that we blend into that segment. It can include elevator components, etc. So it's a little bit a broader segment. And the way we are organized, we have dedicated teams that are taking care of our customer for the different segments. The second axe for our development, except the segment development, is obviously our geographical penetration. As I mentioned before, one of our strengths is the quality of the customer portfolio we have. We have in most of the product we produce leaders in their field. And the way they grow is also through their geographical expansion and through acquisition. So for us, it's extremely common to be requested to support them in a new geography that they will penetrate or to start to manufacture for a new company they have. And from that perspective, we look at how we can improve our footprint to help those customers. That's why 2 years ago we decided to build electronic manufacturing in the USA, and that's a line that we are now fulfilling with customers that have been historical customers from us, but with new projects. That's also why we acquired an operation in Australia and in Malaysia, because we were getting the demand from customers to have manufacturing in Asia outside of China. So that's the way we develop. And as you understood, I mean, we do it either through organic growth, meaning that we develop capabilities in existing factories, or we do it through acquisitions. Coming to our customer portfolio, when we look at the split that I mentioned before, to give you an idea of the weight, industrial is the biggest one, 47%, followed by energy, clean tech, and medtech. We have our top 10 customers that weigh about 50% of our portfolio. And that's something I like to comment because it is sometimes a little bit of a misleading number. And I think that you will immediately understand why. As I mentioned, the customer we have are usually very sizable companies. You will recognize that most of those companies have at least several business area or division, depending how they want to call it, that will also include several companies. So which means that in reality, it's very common that in our top 10 customers, they are manufacturing in maybe all of our facilities. I mean, some of them are actually manufacturing in all our facilities, or we are manufacturing for them in all our facilities. And there also we are manufacturing, can be hundreds or thousands of different products. So I will say the simple picture of 10 customers is much more complicated when you look behind the curtain. And we have been, during the last year, very active on capturing new contracts. And we have started to release the number of contract wins we have, which was a new element for us. And during 2024, we won about 190 million, slightly below 190 million euros of contract. And the way to read it is we need a certain number of new contracts to maintain the business at the level it is, just because product lifetime at one point needs request replacement. A product get to an end of life, and therefore you need to remain to win it. So we say that around 10% of our revenue needs to be won every year to be flat. Then the rest come on top. And we believe that the time of implementation for a project is between 6 to 18 months. I mean, depending on the complexity and the ramp-up time. Quickly on the financial summary. We have had a CAGR around 13% over the last year. 23 was a bit of a special year that was driven by shortage of components that boosted the market, but then we paid that back in 24. The benefit for us has been that we have used 24 to work on flexibility and how we adjust our cost to the different cycle. And I think that maybe for one of the first time in our history, we have managed to keep the margin even when facing a decrease of volume of roughly 15%, which we have been quite happy with. And you can see that we have had an increase of our profit level by 17%, a bit higher than the organic growth. And to conclude, we have an outlook for 25 to return to growth. We have communicated guidance between 780 and 920 million euros and operating profit between 53 and 66 million. We continue to build pipeline on the segment we have identified, and we continue to develop our network either through organic or through acquisition. I think that we are getting to the time.
Super interesting. Maybe I will start with asking, you quite a broad footprint, right? And at this day and age, it's quite volatile out there. So maybe a couple of words on what demand is like right now on the ground and what your customers are saying.
Yeah, I think the two things. I think clearly we went through a phase where customers were basically correcting their inventory. That phase is over for us. So now we are in a phase where we are restarting to see a more normal way from operating of the customer. Then for us, there is something a bit special that we won actually a lot of contract last year, which is that Q1 is a quarter where we have a lot of activity in implementing those contracts. So all in all, as I said, we have an outlook that is positive towards the overall year, because we believe we are coming back to growth, both because we have reached a bottom in demand, and because we have reached also a situation where we are manufacturing things we did not manufacture before.
And when you say you won a lot of contracts, is it any specific region standing out, any specific segment standing out?
Yeah, I think that we have a very good dynamic in energy clean tech right now. In medtech right now. We're starting by that is something that we had a strong focus on and is moving forward. Already the last quarter of last year, we saw return to growth on that segment. And then after that, I think that the two other segments are coming a bit after. And then finally, the regions, I will say we can see nicely China getting alive again, which is good for us because most of what we manufacture in China is actually getting consumed on the Chinese market. We have very little export outside of China from what we built. And then we also see a level of activity in the US that we have seen coming during the second part of last year. But obviously we are ramping up the demand, and there is actually a lot of discussion ongoing based on the current geopolitical environment with customers.
And does it feel like it's the underlying environment driving this, or is it you being, ramping up, as you say, in the US, or is it a combination of both?
I think in the US it's a combination of both. I think obviously us ramping up at the moment where people feel that, okay, maybe we should produce in US, it's a good timing.
And then maybe on the margins. So you have a target of 7%, and you were 6.8 the year before last, you were 6.8 this year. So I would assume that you're taking down your cost base. So for you to get to 7% sustainably, is volumes going to be enough? So if you have volumes coming back, that you should go above 7% and stay there?
I think absolutely. I think we have been defending I will say the 7% basis during last year, 6.8, 7 was very close. We have also tried during that period to keep going with strategic investment. I mean, we didn't impacted our investment. We have moved our long-term plan. We moved our focus to medtech. So we were quite happy to keep that base and still move the strategic investment we wanted to move forward. Then obviously volume will contribute to that for a very simple reason. You could say that today we are probably 70% occupied in our factory, which is a bit, in a way, too low level. So we will get a leverage from that.
Okay. Christophe, I think time is more than up. So thank you very much for coming here to talk to us, and thanks for listening.
Thank you.